Moody's has raised concerns about the U.S. economy's trajectory, estimating a 48% chance of recession, marking the highest risk level since 2020. This forecast follows disappointing job data, including a substantial downward revision of payroll figures by 911,000 jobs, which Moody's interprets as a potential precursor to an economic slowdown. Mark Zandi, chief economist at Moody's Analytics, highlighted the reliance of the U.S. economy on spending by the wealthiest segment of the population. He cautioned that a reduction in spending by this group could precipitate significant economic challenges. Concurrently, the U.S. Federal Reserve has expressed apprehension regarding employment stability and inflationary pressures. In response, the Fed has lowered its benchmark interest rate by 25 basis points to a range of 4.0 to 4.25%. This adjustment aims to mitigate economic risks and stimulate growth. Notably, the top 10% of income earners now contribute to nearly half of the nation's consumption, a record high since data collection began in 1989, underscoring the economy's dependence on affluent consumers. The interplay between these factors will be critical in shaping the economic outlook, influencing market sentiment, and guiding future monetary policy decisions.
At a recent forum hosted by the Yale Chief Executive Leadership Institute, over 100 top CEOs and political leaders discussed the detrimental impact of President Donald Trump's economic policies on business. The forum operated under Chatham House rules, enabling open discussion about the challenges posed by the administration's strategies, particularly tariffs. A consensus emerged that these policies are undermining the established U.S. economic framework, historically beneficial under both Republican and Democratic administrations. The primary concern among CEOs is that tariffs, intended to protect domestic industries, have instead increased costs for businesses and consumers. Two-thirds of the CEOs reported adverse effects on their operations, with companies like Ford, Nike, and Gap publicly voicing similar issues. Efforts to mitigate these costs through supply chain adjustments and operational changes are becoming unsustainable as pre-tariff inventories deplete. The tariffs also face legal challenges, with nearly three-quarters of executives agreeing with court rulings, deeming them illegal, adding to the uncertainty. Despite initial support for initiatives to bolster domestic manufacturing and national security, CEOs are troubled by the negative impact on America's international standing and economic stability. The labor market remains sluggish, described as low firing, low hiring by Federal Reserve Chairman Jerome Powell. And inflation has risen, contrary to the administration's objectives. This environment of uncertainty has led to hesitancy in making long-term capital investments. The Business Roundtable, a significant advocacy group, has remained silent, leaving CEOs to address these challenges with limited support. Overall, the forum highlighted the growing discontent among business leaders regarding the sustainability of current economic policies and the need for a strategic shift to restore America's economic stability.
The recent clarification by the U.S. government regarding the H-1B visa rules has provided a degree of relief to Indian IT companies, as it exempts returning visa holders from the newly imposed $100,000 fee. This development is critical for major Indian IT firms such as Infosys, Wipro, Cognizant, and Tata Consultancy Services, which employ a significant portion of H-1B visa holders. Analysts predict a moderate decline of 3 to 5% in IT stock prices, suggesting that the impact will be manageable in the short term. Furthermore, the clarification that H-1B petitions filed before the September 21 deadline will not be subject to the new fee could prevent further immediate disruptions. Despite the temporary relief, the broader context remains challenging for Indian IT firms. The Nifty IT index has already slipped by approximately 16% year-to-date, reflecting ongoing market pressures, while the Nifty 50 has risen by about 7.1%. The new visa fee structure, expected to generate over $100 billion for the U.S. Treasury, is part of a broader strategy to reduce national debt and implement tax cuts. However, critics argue that these measures could hinder talent mobility and innovation. Indian IT companies are increasingly reducing their reliance on H-1B visas, with a growing share of their U.S.-based workforce being hired locally. This shift, coupled with potential alternatives like relocating employees to Canada or Mexico, suggests a strategic pivot in response to evolving regulatory landscapes.
The recent settlement between the National Association of Realtors, NAR, and a group of home sellers, which was expected to reduce the standard real estate agent commission rates, has not led to significant changes in practice. The settlement aimed to decouple the commission structure, traditionally split between the buyers and sellers' agents, encouraging separate negotiations. Despite this, the prevalent commission rates remain largely unchanged, with sellers continuing to cover the buyer's agent fees, typically around 2.5% to 3% of the home's sale price. This is evident from the unchanged average buyer's agent commission of 2.43% in the second quarter of 2025, as reported by Redfin. The settlement's lack of impact is attributed to the new requirement for buyers to sign a buyer-broker representation agreement, which specifies the agent's fee and obligates the buyer to pay if the seller does not. This has inadvertently maintained the status quo, as sellers feel pressured to cover these fees to avoid deterring potential buyers who might not afford the additional cost. The U.S. Department of Justice has expressed concerns that these agreements could harm buyers and limit broker competition. However, proponents argue that these contracts enhance transparency and allow for fee negotiation, although industry norms and brokerage pressures often keep fees at traditional levels.
In a significant move within the credit card industry, American Express and Chase have announced substantial increases in annual fees for their premium travel rewards credit cards. American Express has raised the fee for its Platinum card to $895, up from $695, marking a 29% increase. Similarly, Chase has increased the annual fee for its Sapphire Reserve card to $795 from $550, a 45% hike. These changes highlight a broader trend of rising costs associated with premium travel credit cards, which are often justified by enhanced perks such as airport lounge access, travel credits, and loyalty program benefits. This trend is not isolated to American Express and Chase. Citi has introduced the Citi Strata Elite with a $595 annual fee, and Capital One has adjusted the terms of its Venture X cards by limiting free guest access to airport lounges. The escalating fees underscore the importance for consumers to assess whether the benefits offered by these cards align with their spending habits and travel frequency. Experts advise that while these cards can offer significant value through rewards and perks, carrying a balance can quickly erode these benefits due to high interest rates, which can range from 25% to 30% for premium cards. For frequent travelers, particularly those loyal to specific airlines or hotel chains, co-branded credit cards may offer substantial value through benefits like free checked bags and priority boarding. However, for those seeking flexibility, general travel cards might be more advantageous, offering broader reward options. As the landscape of travel credit cards evolves, consumers are encouraged to carefully evaluate their travel patterns and financial habits to determine the most cost-effective option, ensuring that the annual fees are justified by the card's benefits.
BigBear.ai experienced a significant surge in its stock price, rising 35.4% this week, outperforming the S&P 500 and Nasdaq Composite, which gained 1.2% and 2.2%, respectively. This substantial increase was primarily driven by the Federal Reserve's decision to cut interest rates by 25 basis points, alongside indications of further rate cuts within the year. This monetary policy shift has fueled investor optimism, particularly benefiting speculative growth stocks like BigBear.ai, which are often more sensitive to changes in interest rate expectations. Despite the positive market reaction, BigBear.ai's underlying business performance raises some concerns. The company reported a disappointing second quarter loss of 71 cents per share, significantly missing Wall Street's expectations by 65 cents per share. Additionally, its revenue of $32.5 million fell short by $8.1 million, and the company revised its full-year sales guidance downwards. While the excitement around AI applications in the defense sector remains a potential growth driver, the current financial metrics and revised outlook suggest that the company may face challenges in capitalizing on these opportunities effectively. As such, while the stock's recent gains reflect market sentiment, they may not fully align with the company's operational performance.
Broadcom Inc., Nasdaq, AVGO, has seen significant activity among institutional investors, with Anderson Hoagland and Company reducing its holdings by 14% during the second quarter, as disclosed in their recent SEC filing. Despite this reduction, Broadcom remains a highly favored stock among hedge funds, with PARUS Finance UK Limited and other firms notably increasing their positions earlier in the year. This activity reflects ongoing confidence in Broadcom's market position, despite recent insider sales by key executives, including CEO Hock E. Tan, who sold a substantial portion of his shares in September. The semiconductor giant has been the subject of positive analyst sentiment, with several firms including Mizuho, Barclays, and HSBC raising their price targets on Broadcom shares, now averaging $356.48. Analysts highlight Broadcom's robust financial performance, evidenced by its recent earnings report where the company exceeded EPS expectations and reported a 22% year-over-year revenue increase. Broadcom's strategic focus on semiconductor solutions and infrastructure software positions it well in the market, contributing to its strong return on equity of 36.60% and net margin of 31.59%. The company's financial health is further underscored by its manageable debt-to-equity ratio of 0.86 and a solid dividend yield, offering a $2.36 annualized dividend with a payout ratio of 60.20%. Overall, Broadcom's stock performance and strategic direction continue to attract significant institutional interest. Despite some insider selling, the company's ability to consistently deliver strong financial results and maintain a positive outlook among analysts suggests it remains a compelling option for investors seeking exposure to the semiconductor sector.
Prime Minister Narendra Modi has announced the launch of the GST Bachat Utsav, coinciding with the start of Navratri, which will see significant reforms in the goods and services tax (GST) structure. Starting September 22, the revised GST rates will reduce the tax burden on a wide range of goods and services, including everyday staples, electronics, medical supplies, and automobiles. These changes are expected to collectively save Indian citizens over 2.5 lakh rupees crore in 1 year. Additionally, the recent income tax exemption for annual earnings up to 12 lakh rupees aims to provide further financial relief, particularly to the middle class, and stimulate consumer spending. The GST Council's decision to lower tax rates on nearly 375 items is part of a broader strategy to enhance economic growth and simplify business operations under the Atmanirbhar Bharat initiative. Finance Minister Nirmala Sitharaman highlighted that this rationalization could inject approximately 2 lakh rupees crore into the economy, increasing disposable income and potentially boosting consumer demand. This reform is anticipated to benefit various sectors, from construction to consumer goods, and is likely to influence market sentiment positively, making investments in India more attractive while fostering equitable growth across states.
UMB Bank N.A. has reduced its stake in Quanta Services, Inc., NYSE, PWR, by 36.7% in the second quarter, now holding 10,958 shares valued at $4,143,000. This move is part of a broader trend among institutional investors adjusting their positions in the construction company, which provides infrastructure solutions across various sectors including electric power and renewable energy. Despite the trimming of positions by some investors, Quanta Services has shown robust financial performance. In its latest quarterly earnings report, the company posted a revenue of $6.77 billion, surpassing analysts' expectations and marking a 21.1% increase from the previous year. The company's earnings per share, EPS, also exceeded forecasts, reporting $2.48 against an anticipated $2.44. Quanta Services stock has experienced minor fluctuations, currently trading at $389.34, with a 12-month high of $424.94. The company's market capitalization stands at $58.01 billion, and it maintains a relatively healthy financial position with a debt-to-equity ratio of 0.59. Analysts have mixed views on the stock, with some lowering their ratings from outperform to market perform, while others have raised their price targets, reflecting a consensus rating of moderate buy and a target price of $401.19. The firm's strategic focus on electric power infrastructure, including smart grid technologies and renewable energy projects, continues to drive its growth prospects in the evolving energy sector.
Harbor Capital Advisors LLC recently acquired a new stake in Sunoco Products Company, purchasing 4,550 shares valued at approximately $212,000 during the second quarter. This acquisition is part of a broader trend where institutional investors and hedge funds are adjusting their positions in Sunoco Products, a company known for its engineered and sustainable packaging products. Notably, Millennium Management LLC significantly increased its stake by 739.7% in the first quarter, now holding over 1.15 million shares valued at $54.44 million. Similarly, Dimensional Fund Advisors LP and Valley Wealth Managers Inc. have also expanded their holdings, indicating a growing institutional interest in Sunoco's stock. Sunoco Products has shown a steady stock performance, opening at $46.32 with a market cap of $4.57 billion. Despite missing its quarterly earnings estimate by 7 cents, reporting an EPS of $1.37 against the expected $1.44, the company experienced a revenue increase of 17.7% compared to the same quarter last year. Analysts remain optimistic, with several upgrading their price targets for Sunoco, reflecting confidence in its future performance. The company maintains a healthy dividend yield of 4.6%, with a payout ratio of 37.99%, appealing to income-focused investors. With a moderate buy consensus and an average price target of $57.63, Sunoco Products continues to attract attention from both analysts and institutional investors, suggesting potential growth and stability in its market position.